All right, good to have you all. Hopefully that worked out. That opening activity for you may not have been enough time, but wanted to get the conversation flowing. So I'm going to just give us a little intro to these sessions. We do possibly have some new people joining us since the first round of 3. So these are a chance for us to build connections and collaboration between IDA staff from across Oregon. We are going topic by topic to refresh or introduce the core content from the standards, as well as practicing shifting the narrative in the context of our shared work. If you've been with us for a while, you've likely heard the analogy of learning to swim in a pool versus learning to swim in a river or having to swim in a river. And so we bring that back just to remind us that we are attempting to pull ourselves kind of into an area where we are rethinking about what the circumstances are that people are in as they build their financial capability and resilience in the context of financial education. So with each topic, we have economic literacy, which is part of our goal to incorporate into each of these sessions to talk about more of the systemic view. These webinars give us a chance to discuss and explore some ways to incorporate economic literacy as we outline them in the FE standards and just try and bring us into conversations about more of the systemic perspective. And on their own, these webinars will not equip you to teach this topic. That we don't have enough time to do that, but we do hope that as a community of practice, these help you gain some new approaches or ideas for growing your own financial education or coaching that you are offering at your organization. So welcome. I'm going to pass it over to Randy.
Yeah, so continuing with the community of practice, we also enrolled the practice that NP has really been working on in our equity work around community agreements. And so we're lifting up these particular agreements to help create a brave, inclusive, and equitable space for ourselves. So staying engaged, engaging tension, but don't indulge the drama. Speak your truth responsibly for yourself, for others, for the space. Growth mindset, it's a learning space. Be open to learning. And then confidentiality, take the lessons, leave the details. So these are the community agreements we'll hold and try to honor as a collective throughout the space and the learning.
Today's session is focused on topic 5, which is on financial institutions. We've adjusted the order because what we cover today will help build the foundation for topics 4, 6, and 7. And so in November, we'll have another session and we'll just hop right back to session 4 or topic 4.
All right. Now we're going to try to have some more fun. We haven't been having quizzes in the space. Why not bring them back? So we'll do some pop quizzes. So we're going to have a little fun. So we have the prompt here. We're going to access a survey that basically is looking at how people engage with mainstream financial services like banks. And so before we start that, I just kind of want to give 2 definitions, and then we're going to do some true or false. You'll get to answer the polls as they pop up, and then we'll engage with what the answers are and what the information is. So we're going to start by unpacking what these following definitions are. Unbanked, do not have a checking or savings account. So this is roughly about 5% of US households. Underbanked, having a bank account but rely on non-banked alternative financial services to meet expenses. This includes check cashers, cash transactions, prepaid cards, money orders, payday lending, pawn shop loans, and title loans to receive income, make purchases, and pay bills. And it comes at a heavy cost, as many of us know, estimated at about 70% of US households using this. So those are frames and definitions. And now we'll go into the pop quiz itself with the first one. So true or false, on-bank households don't have accounts primarily because they don't trust banks. On-banked households don't have accounts primarily because they don't trust banks. Well, that was a big
All right. It's a tight one. We got a few more people voting. There's a few more out there. Everybody check your screen. Give us your answer, true or false. All right, I'm gonna share the results here. All right, Randy, can you see those?
I believe so. You can tell me if I'm reading it wrong or right, but according to our poll and our pool of people, 56% of the people in this space believe that it's true. Actually, according to the other survey, it's false. 29% said because they don't have enough money to keep in the account is the main reason. And the others said they don't trust banks. So in this space, 56%. Is that right, Luke?
Yeah, so you all got it wrong. I'm gonna say over half of you guessed wrong. The polls say that it's not because they don't trust banks, it's because they don't have enough money. Okay, so I've launched our second one here.
Second one, true or false? The unbanked have low awareness of bank accounts and their benefits. The unbanked have low awareness of bank accounts and their benefits. True or false?
All right, the last results are trickling in. All right, here's the results.
All right. So in our space, 65% believe that it's true, and that's wrong. Because according to the polls, it's false. About 50% have had an account before.
All right, you all are 0 for 2 overall as a group. Sorry to say. You've got one more chance.
Just stickler for them. You better get these right. All right, number 3. The unbanked primarily use transaction products like check cashing and bill pay services, not credit products like payday loans. True or false? Unbanked primarily use transaction products, not credit products. True or false?
All right, a few more people. Don't be shy just because you got the first couple wrong. It's okay. Okay, give us your answers. True or false on this one?
Growth mindset.
Primarily use transaction products like check cashing, not credit products. All right, here's our results.
All right, so based on our group, we're going with false at 63%. But according to the polls, it's true. For them at about 80% only use transaction products, while 20% of the unbanked use alternative credit products. So womp womp. Over 3 for us, but that's why we're in the learning space. It's not always what we think it is, and that's what we're here to do, is to learn. And I think the main thing is this allows us to lift up just a couple of the myths that we were pulling from kind of putting some of this work together and thinking on barriers to banking. And we will provide you with a list of others. I think Julie will post that in the chat for those who are interested in accessing some more of that information. And then transitioning and looking at this slide. That poll. Okay. So when you're looking at this, what we see here is Black and Latinx families are overrepresented among the unbanked and underbanked. And of the 7.1 million households that are underbanked, 64% are Black and Latinx. Of the 22.9 million households that have a bank account but use non-bank credit or transaction products in 2020, 47% were Black and Latinx.
This isn't surprising considering the long history of systemic racism in our financial institutions. In session 2 of our Economic Legacies Matter series from 2021, We covered some of the key historical events and policy decisions that have shaped our financial system. We'll paste the link to that full session if you want to dig deeper into some of the pieces. What we're going to review right now is a synopsis of that session. It's meant to remind us of that legacy, but not provide the time necessary to deeply engage in the significance of this history. So to recap, we talked about like this deeply rooted systemic racism from the founding of our country, which starts with the transatlantic triangle. And it was built on a legacy of enslavement and colonization. People were traded in order to build capital for other people. Enslaved people were considered, next slide, assets, and insurance policies were purchased to protect slaveholders from losses. Enslaved people were used as collaterals for loans. The New York Stock Exchange was one of the largest slave markets in the country and greatly benefited from the cotton trade. A promise of reparations was made to freed slaves, 40 acres and a mule, and that promise was broken within a year the order was issued. Freedmen's Bank was established to aid newly freed Black people. In just less than 10 years, mismanagement by bank directors caused the banks to fail, stealing $3 million in wealth from 61,000 Black depositors. In general, communities of colors have been systemically excluded by financial institutions. The practice of redlining was legal up until 1968. This is a map of Portland showing where banks could or would and wouldn't offer home loans. Assets were stolen and treaties with Native communities were broken, impacting economic development and the survival for Native Americans. Barriers to low-cost financial products due to citizenship status means that a whole community of people continue to be explicitly denied access to banking, credit, and lending. And we've shown this chart before, and it's obviously too small for you to read on the screen. But if it's your first time considering the impact of the history and government actions on community wealth building, we encourage you to watch the recording of some of the past economic legacy matters sessions. These financial roadblocks have been consistent throughout the history of the country. White male landowners benefited from these systems at the expense of others, particularly Black and Indigenous people. Ignoring or dismissing these injustices and their continued effects is harmful. Without this recognition, marginalized peoples, internalized systemic failures, and financially well-off people erroneously attribute their successes solely to their individual efforts.
All right, so we're just running through. I want to remind you all that all those slides were from last year's session. That did not do it justice, and please watch that session if you weren't a part of that last year. We did 3 sessions called Economic Legacies Matter, where we talked about the systemic perspective on financial education issues. So we challenged the narrative of why people are unbanked early on in this session using those polls, but we also want to bring to light some of the systemic structures that we operate in. And we're going to start with a video that gives a basic overview of how monetary policy works in the US. So I'm going to play that video and then we'll continue on.
If you tried to pay for something with a piece of paper, you might run into some trouble. Unless, of course, the piece of paper was a $100 bill. But what is it that makes that bill so much more interesting and valuable than other pieces of paper? After all, there's not much you can do with it. You can't eat it. You can't build things with it, and burning it is actually illegal. So what's the big deal? Of course, you probably know the answer. A $100 bill is printed by the government and designated as official currency, while other pieces of paper are not. But that's just what makes them legal. What makes a $100 bill valuable, on the other hand, is how many or few of them are around. Throughout history, most currency, including the US dollar, was linked to valuable commodities, and the amount of it in circulation depended on a government's gold or silver reserves. But after the US abolished the system in 1971, the dollar became what is known as fiat money, meaning not linked to any external resource, but relying instead solely on government policy to decide how much currency to print. So which branch of our government sets this policy? The executive, the legislative, or the judicial? The surprising answer is none of the above. In fact, monetary policy is set by an independent Federal Reserve System, or the Fed, made up of 12 regional banks in major cities around the country. Its Board of Governors, which is appointed by the President and confirmed by the Senate, reports to Congress, and all of the Fed's profit goes into the U.S. Treasury. But to keep the Fed from being influenced by the day-to-day vicissitudes of politics, it is not under the direct control of any branch of government. So why doesn't the Fed just decide to print infinite $100 bills to make everyone happy and rich? Well, because then the bills wouldn't be worth anything. Think about the purpose of currency, which is to be exchanged for goods and services. If the total amount of currency in circulation increases faster than the total value of goods and services in the economy, then each individual piece will be able to buy a smaller portion of those things than before. This is called inflation. On the other hand, if the money supply remains the same while more goods and services are produced, each dollar's value would increase in a process known as deflation. So which is worse? Too much inflation means that the money in your wallet today will be worth less tomorrow, making you want to spend it right away. So while this would stimulate business, it would also encourage overconsumption or hoarding commodities like food and fuel, raising their prices and leading to consumer shortages and even more inflation. But deflation would make people want to hold on to their money, and a decrease in consumer spending would reduce business profits, leading to more unemployment and a further decrease in spending, causing the economy to keep shrinking. So most economists believe that while too much of either is dangerous, a small, consistent amount of inflation is necessary to encourage economic growth. The Fed uses vast amount of economic data to determine how much currency should be in circulation, including previous rates of inflation, international trends, and the unemployment rate. Like in the story of Goldilocks, they need to get the numbers just right in order to stimulate growth and keep people employed without letting inflation reach disruptive levels. The Fed not only determines how much that paper in your wallet is worth, but also your chances of getting or keeping the job where you earn it.
So, post that brief overview, starting in March of 2020, in an effort to prevent the U.S. economy from spiraling into a depression, the Federal Reserve launched an unprecedented effort to keep money flowing to companies, households, and cities by purchasing corporate bonds, treasury securities, and mortgage-backed securities to ensure that the flow of credit to the broader economy. The Fed pumped like over $4 million into the economy over 18 months. Using these measures and more, this is something that the Federal Reserve did on its own, showing its enormous influence over the economy. But to be clear, these actions were independent of subsequent CARES Act and the American Rescue Plan Act bills that created the Paycheck Protection Loan Program, enhanced unemployment funds, stimulus checks, enhanced EBT, and advanced child tax credit payments.
Just to go back to what Randy was saying, it was $4 trillion and not $4 million. So $4 trillion into the economy over 18 months. But all of the Fed's actions were made possible because since 1971, US dollars are known to be backed by the full faith and credit of the United States government. It's legal tender for all debts and public and private, but not redeemable in lawful money at the United States Treasury or at any Federal Reserve Bank, as printing on the US dollar bills used to claim. In this sense, US dollars are now legal tender rather than lawful money, which can be exchanged for gold, silver, or any other commodity. One of the advantages of having a fiat money system is that it allows for fractional reserve banking. We're going to show you a video on how that works.
Hey, you ever wonder what happens to the money you deposit at your bank? And why are they willing to pay you interest when they have to do all the hard work of keeping your money safe? Now, what if I told you the banks are artificially creating money every day? All that and more in today's episode of 5-Minute Finance. Let's start with the basics. You deposit your money at the bank and they give you a small amount of interest. Then, they take that money and lend it to people and businesses while charging a much higher interest rate. The difference between the interest they charge on their loans and the interest they pay you is the profit that the bank makes. This is why banks are willing to pay you interest for your deposits. In order to lend more and make more money, banks need to attract more money from deposits because deposits create loans. But aren't the banks supposed to be keeping your money safe somewhere so that you can take out your money when you need it? Well, sort of. Banks have a unique system called fractional reserve banking, which basically says that only a fraction of deposits, usually around 10%, need to be held in cash and they can loan out the rest. This amount is set by the Federal Reserve and acts as a cushion for when customers want to withdraw cash from their account. Now here's where the money-making magic comes in. Let's say you deposit $10,000 into your savings account. If the reserve requirement is 10%, the banks must keep $1,000 and can lend $9,000 out to another customer. Now, you have $10,000 in your account, another customer has $9,000 in cash, and suddenly, your $10,000 deposit turned into $19,000 worth of money. Then, that other customer deposits their $9,000 at their bank, which again holds on to 10% of it and lends out the rest, and so on and so on. You see where this is going. This is how banks increase the money supply, otherwise known as the total amount of money in circulation, without increasing the amount of physical cash moving around. Wait, hold up. Earlier, I said that deposits create loans. Banks need to attract more money from deposits because deposits create loans. But when our bank lent $9,000 to a customer, who then deposited the cash, that created a $9,000 deposit. So isn't it more correct to say that loans create deposits? You might think that the fractional reserve requirement limits how much money a bank can lend, but the reality is that these requirements do very little to limit banks from lending. In fact, many major banks typically create loans first, then deal with the reserve requirements afterwards by getting new deposits or borrowing money from other banks at a low interest rate. So what really keeps bankers from abusing this system of constantly creating new loans to make more money? Well, the first limitation is profitability. When a bank makes a loan, they aren't just thinking about the interest they charge on the loan. They must also consider the costs of running the bank and the potential losses they face if a borrower is unable to repay. The other major limit on bank lending is capital requirements. Put simply, capital requirements are the amount of capital a bank must hold relative to its total lending. Capital can be thought of as the amount of profits that must be kept within the bank instead of distributed to shareholders. With these limits in place, most banks should be relatively safe from failing, but if you're worried about losing the money you deposited at your local bank, fear not. Most banks these days are insured by the Federal Deposit Insurance Corporation, or FDIC. The FDIC is a government organization that insures up to $250,000 of your deposits so that your money is safe.
Sorry, I'm having issues getting my mic on. So now we're going to do a live word cloud, continuing to use Minty. So thinking about the information that we just learned in the session about the U.S. monetary policy, which was explained in the very first video, and the fractional reserve banking, which was explained in the second video, we're going to ask you to add 2 different words that describe your thoughts and feelings about this system. And the link will be posted in the chat. I'm just going to put that in the chat for you to access the Minty. But put 2 different words together that describe your thoughts and feelings about the system that come to mind for you. And then Luke will share them and we'll pull out some things and see what comes up.
If this works, words should start appearing. Hey, there we go.
No.
So pop in your words, go to the link.
That was
Thoughts
definitely-
and feedback.
That was one of my words. It was confusing. Huh? That's my word and sound. Hmm? So we have unethical, confusing, outdated, not secure, bank power, clever, huh? Confusing, unfair, Ponzi, capitalist, non-inclusive, abstract, see wow, risky, crooked, exploiting, white, entrenched, imaginary money, see a lot of retirement account growth. So continue to put those things into the chat. I'm going to stop calling them into the space and then open it up and create an invite for folks to pull into the space, just, you know, in a large group, just conversation or share any reflections that you have about US monetary and banking systems. Like, does anybody want to share verbally or out loud into the space their feelings on that? At this time, we have about 5 minutes, so we can just open it up, share our thoughts.
I think, hello everyone, LB from Community Action, she, her pronouns. The first thing that came up for me was, I can't believe we get charged overdraft fees if they're making money off of our money. But that was the first thing, as soon as I saw the explanation.
Facts. Others?
Yeah, well, I come from the world of banking, so I was a banker for like almost 10 years. And so I sort of can see both sides of it. But I think what's interesting, one is if banks really act ethically and are not doing racist practices, I think the whole system can work fairly well. I also think it's amazing how fragile our entire economic system is. Which we've seen with 2020 and 2008, just like how even just little things go wrong, the entire system can kind of fall apart.
Valid point and a healthy tension to hold both.
I appreciate Jeff pointing out that if the ethical part of it was improved, that most of it would work. I'm struck that the other half of that is that there's a lot of problems with currency tied to commodities also. So I'm not sure what the perfect system would look like.
Anybody else?
Yeah, I was like feeling really uncomfortable to think that you know, when we talked about the first game, like what is your bank, what do you like banking about it? I was like, there's nothing that I like doing it, but I do it. And it felt very much like one of those cultural things that you do. And you don't even like it and you don't understand it, but you just do it. You just like follow like the sheep, like this is what you do right now, you know? And I don't know. I feel like very much with lack of power about making an impact about, like, you know, what the banking system should look like, or what are the things that we would like to see, because it's just like so unknown, right? It's very, very, very unknown. So that's what I was thinking.
Appreciate that share, Gina, and the share of vulnerability in space. And it just makes you want to call in that word that came up of abstract. I think that's a callback to that. We have time for one more. Is anybody else want to?
I'll say something. I feel it's very deceptive in how they operate, and for many reasons. We know all the damage they've done to people in many, many ways, particularly the big banks, but also on an ongoing basis. Just let me point out that most people get a electronic statement, and they don't check their statement, and the bank lures them in by saying their services are free, and then lo and behold, they try to set them up, buying more like products, let's say their checking account, and then savings. They'll push the savings because they know in time they're going to start charging for that, or you have to have a minimum balance. And then they start charging people $10, $15, $20 a month. So very deceptive, and it's definitely unethical.
Thanks to everybody who shared and brought that into the space, whether it was in the word cloud or via your voice in the virtual box. With that, we'll pivot here and move to the next portion of the presentation.
Yeah, thank you all. Good reflections. Let me find my place here. So for most of the history of this country, banks were heavily regulated to avoid the concentration of wealth and power. The government restricted the regional reach of each bank. Interest rates were mandated to be the same across institutions. Some of you may be old enough to remember when banks offered giveaways to attract new customers. Some examples are toasters, raffles for ponies, cars, vacations, and pocket watches. I think you see a Wells Fargo pocket watch here on the screen.
These regulations were accepted because banks were regarded as a public utility. Access to credit for individuals and businesses means economic advancement, and limits on credit results in economic stagnation. In 1980, a portion of the Monetary Control Act deregulated banks, allowing them to merge. Between 1980 and 1994, 169 bank mergers occurred. 3 banks with the greatest numbers of acquisitions are Bank of America, JP Morgan Chase, and Wells Fargo. Now, a handful of institutions have extraordinary amount of power and influence on our financial markets and our access to credit. The financial lobby convinced elected officials and regulators that the bank's best interests are also the best interests of the people. They insisted that the onerous regulations would stifle the flow of money and in turn negatively impact the economy. Our officials agreed, and over time, the result of the hands-off approach resulted in the Great Recession of 2007 through 2009. So Luke is going to paste this really interesting flow chart, and it's a bank's consolidation flow chart into the chat box, so that later, if you want, you can see over time the vast number of banks that have been acquired by just a handful of big corporate banks.
So banks are different. They're different than any other business in this country. They exist almost as an extension of our government. The relationship between the two are very much intertwined. Government supports the banks through, as you can see listed here, trust-inducing deposit insurance, bailouts, lender or last resort liquidity protection, providing a framework that allows the allocation of credit to the entire economy. Banks operate as the central machinery of the economy by, as we see here, providing transaction services, a medium for trade, making loans to individuals and businesses that spur economic growth. And so access to credit is a key component of economic security, but a large portion of the mainstream credit market is monopolized by financial institutions that are not interested in servicing low and moderately income individuals. Banks want all the benefits of government support and none of the obligation to serve all of its residents.
So in the chat box, I'm sure you're at least familiar with the term of the Community Reinvestment Act, but I wanted to see if those of you who do know about it, if you could quickly type a couple of sentences describing your understanding of what the credit or the CRA actually does. Okay, Gina says urban renewal. All right.
Don't be shy, people.
Yeah, I mean,
Or say, I don't know, if you don't know. We're curious.
all right. Supports the local community, funds home ownership programs. Yep. Where banks focus their investments. Yes, absolutely. Okay, so the Community Reinvestment Act was passed in 1977 to encourage commercial banks and savings associations to help meet the needs of borrowers in all segments of the community, including low and moderate income neighborhoods. The law, however, emphasizes that an institution's CRA activities should be undertaken in a safe and sound manner and does not require institutions to make high-risk loans that may bring losses to the institution. So when a bank receives a negative rating, the institution is prevented from opening new branches or merging with another bank, and more frequent CRA examinations are required. So Luke's going to paste another link, and it's a list of activities which banks earn CRA credit. So if you've ever wondered why banks approach you to teach financial education classes, or they want to donate computers for your nonprofit program, this is a very extensive but not exhaustive list of activities that give banks CRA credits. And so they, can fund affordable housing. They can do all kinds of activities that aren't as risky to the bank's profit bottom line as lending to low and moderate income populations is. So it's really interesting. About a few weeks ago, Randy sent out something called an interlude, and it was an email that talked about the Treasury Department working on updating the CRA to be more responsible to the banking needs of people with low and moderate incomes. However, we must remember that publicly owned banks are profit-driven and have a fiduciary duty to their shareholders. And credit unions were originally created to serve the poor, lobbied and received an exemption from the CRA in 1998 as a part of the Credit Union Membership Access Act. Many of the people who access their services are considered risky and unprofitable to banks and credit unions. So perhaps it's time to imagine a different option. And that's where we're going to start after the break. So we're going to have you guys break and return at about 11:05. Right.
Oh, yeah.
So just really quickly, wanted to call in for those that are new to the space. In the community of practice, we have invited the opportunity for this way of being as practitioners with what we call small group conversation leaders. And what that is basically guide rails for us to stay on topic and for individuals in small groups to kind of step into that facilitator role and just step into maintaining that container. And so the guidelines for that look like trying to keep everything on topic. Silence is a tool. The role is not to fill the space, but to bring out other ideas, multiple questions, try to find ways to get them addressed, clarifying questions, bringing those things to us as a host that need clarification, making sure that, it's equitable time in the space, and then trying to phrase questions in different ways to elicit responses are just contribution from folks. So as always, that's an opportunity for us to lean into our practice and lean into this community of practice. So for those of you that are new, this is something that we've been trying to incorporate as a way of being. And for those of you that have been there, that is the refresh. And with that, the prompt for coming into and going into the next small group is an opportunity for us to do an individual reflection. And so what I would like to ask us to do is to imagine what it would look like for your community if every post office were also a bank that offered free or low cost banking options to every community member. Who benefits? Draw it or write it. And then we'll come back in small groups and you can share. So again, if your community had every post office were also a bank and offered free or low cost banking options for every community member, who would benefit and what does that look like? You could write it, list it, or draw it.
Welcome back, everybody. Hopefully everyone's made it. Super interesting conversations going on. So I'm just going to dive in. The United States Post Office served as a bank from 1910 to 1966. So what you guys were tasked as imagining has already actually happened. It's just been about a generation since it's existed. At its peak in 1947, the Postal Bank held $3.4 billion in deposits with 4 million users. Postal banking could be a solution for the void left by banks that don't serve the needs of low and moderate income people. So some of the things that might be of concern for people in terms of infrastructure and how we do things can be, they have been studied deeply. And so we're going to include some links to videos and studies about postal banking in the Google Doc, the resource document for you to review. But what we want to emphasize is that mainstream banks are heavily supported by the government already. And if banks are unable to make their services available and affordable to low and moderate income people, the government has the underlying infrastructure and capability to provide this service. The Postal Service actually has a charter to provide services without making a profit and has a special relationship with the Treasury Department to kind of give a cushion for, or actually we're gonna kind of maybe jump into this in the next session a little bit deeper, but basically the Treasury Department can use your tax refund to secure whatever loan that you might take from the bank. And so because of these special relationships that the Post Office has with the Treasury Department, some of these concerns can be mitigated. So it's a matter of political will, but people's ability to achieve an economic stability should not rely on a handful of financial institutions that are driven by making a profit. We will give you the link later on for the whole resource list at the end of the session, so you can access that research and those videos at a different time.
So while postal banking doesn't exist at the moment, we hope the awareness of its past existence and the potential to just think about and inspire you to consider the alternatives of the way we do banking here is also an opportunity to advocate to Congress or elected officials if you hear about the opportunity to reintroduce this option, which I heard about it a few years ago through Prosperity Now, which is a national advocacy organization. But for now, we have to work with the system we have to help our clients find the financial institution that will best serve their needs.
Another small group discussion opportunity. So we are going to break into small groups again. Your prompt is here on the screen, but I will overview it for us. So your guiding question is, if banking is a fundamental step in building financial stability and wealth assets, what supports people in deciding to use a bank or a credit union? What account features are most important to look for? And in your small group, can you make a prioritized list of those features? Right. Looks like we're all coming back to the space. So as always, just kind of want to open it up to the large space for folks to share in the larger group. Again, if you had the opportunity to sharing your top three as it relates to the prompt. I had the benefit of being in a group with Kevin, Leah, Nessie, and Brent, so I'm just gonna volunteer them to start us off, whoever from the group wants to start us off, however that looks. But if y'all wanna maybe share.
I forget exactly what wording we used, but it was like familiarity, convenience, and people.
That was it. Exactly.
There was, I mean, it was a lot more, but like breaking it down simply is what it came out to.
Affordability there for you as well.
Laura, let's do ours.
Okay, so our top three were interest rates or fees, so how much it costs to do business with the bank. Do you want all three right now? Yeah. Number two is accessibility and convenience. So that could be physical branches or online presence or however folks interact with their bank. And then number three was customer service and how easy it is to connect with a person when you need help.
I'm going to try to list things that maybe were not listed, even though they might not be the very top, but so staff and then language barriers, if they have bilingual staff or at least translation services for people that are not primarily English speaking, and low barrier credit options or credit building options were a big one, and savings benefits and, good savings percentages.
I can go for our group. Yeah, part of it is community-based, generally lower fees, and also convenience.
Next group. And it's all right if we repeat it. So we have top three. Anybody who hasn't shared, or if there's others folks want to speak to, we have a few minutes.
I don't think that we name a chair, but I'm going to speak in for our group where we talk, and I don't think that we had three things that we agreed, but like we build up onto a few things. Something that somebody brought up is that's safe. Have your money in a safe place is something that helps people decide to have an account versus not having a bank account. The alternative, just have it at home, and all the safeguards that like in the US there are, and also the what is already said, which is the representation at the bank and the ability to communicate with the staff that understands you. You can ask questions, and that's super important for all folks, especially for those who English is not their first language. And the last thing is that that empowerment as a customer, that like you get treated well, but at the same time, like if you is a business relationship, so you can take your business somewhere else. So that is a little bit of an empowerment for our clients.
Thank you, Gina.
That everybody? I'm curious, this is a little bit of an add-on, but people say fees a lot. Can you put in the chat let's name some of the fees that banks, so I heard a new one in the breakout group I was in, a minimum number of debit card transactions. You have to use your debit card a certain number of times or else you get a fee, right? That's interesting. I've not heard that, right? So let's name, what are the fees that to tell clients or for ourselves to be aware of if you were to go out, what fees are you looking for? Let's be specific.
There's minimum account balance fees.
Overdraft fees.
Savings accounts.
Like a fee for just having a savings account particularly?
Yeah, yes, because a lot of the big banks will, again, say it'll be free originally, checking and savings, and then you sign up for both. And then later they'll say, well, we're going to charge you unless you start putting in minimum balance in. And so it's like chicanery, it's, tricking you.
Some charge fees if you don't have direct deposit every month.
Some charge if you withdraw too many times from your savings account. So if you have like an emergency fund and you withdraw too many emergencies, they charge you as well.
Also, I think there's the bigger issue. I don't know of any credit union, there may be, that has, created so much harm, like Bank of America, Wells Fargo, in terms of their deceptive practices of like opening accounts, making people use insurance if you bought a car through them. So, I mean, these are really serious issues that people had their credit destroyed, and some people have never been able to get their credit scores back to they were before because of Wells Fargo and Bank of America's actions. So it's really word maybe staying, they're terrible institutions to work with for a lot of people, and they continue to do that all the time, and they still deny it.
Yeah, certainly. If you're curious, you can look up banks that have been sued for practices, and the list is pretty long. So I'm just going to bring in from the chat: minimum balance fees, minimum debit swipes, minimum ACH transactions, overdraft, withdrawing from the savings too many times, ATM. Yeah, just a monthly fee. I've seen some that are a certain age you don't get, like so to encourage youth, like under 17, there's no fees, but then once you are over 17, I think they probably start adding a fee.
My son was a college student, and as long as he was in school, they didn't charge a fee. But as soon as he was on summer break, once he graduated and they knew what his expected graduation date was, they automatically switched it to a fee-based.
In-person banking fees. Okay, so there's a lot. Appreciate everybody adding. So my transition here is just to think about, this is our handy little Monopoly board of IDA, to talk about, like, somebody has an IDA account, they go through the program, they finish, and what happens with a custodial IDA account? If you use custodial accounts when you're done, it closes, right? You no longer have that account. So that account that was maybe free, no fees, you could say it's a safe account, no longer is there for them. So just kind of putting it in people's minds to think about where is there an opportunity to re-engage savers as they exit the program, to think about, okay, if you want, either maybe you don't have another account, or actually somebody in the breakout group I was in had a great example of sort of modeling what IDA savings accounts do. You could open a separate account for an emergency savings, right? Do you want to open, like, do what IDA has helped you do by putting your money kind of out of sight, out of mind in some ways to build your savings? How do you help somebody think about all the decision points that they might have so that they enter into a bank relationship or credit union relationship that benefits them and that they feel comfortable and able to interact with? So that's kind of the prompt. We're not answering that question, but just to think about, that's a touch point for us to consider as part of this program as well, how it fits in to somebody graduating the IDA successfully. There is Bank on Oregon, which is a coalition that's nonprofits and banks do kind of different, I don't know, initiatives to try and be more transparent. So they have a list of banks and some of the fees or account details on the Bank on Oregon website. It's not super user-friendly in my opinion, but it does provide some transparency. So it's banks that have signed on to a commitment around a certain level of practice for lower income savers. They also are a coalition that you could join if you're interested. The upcoming meeting is actually, they asked me to share this with our network. So next week, they have somebody that's check systems, partnering with CFE to help financial institutions offer safe, affordable checking accounts to unbanked or underbanked consumers. So if you're interested, I don't know much about the presentation, but the Bank On Coalition hosts things like this. If you are curious, feel free to email me and I can send you this information. And maybe I'll include it in the email that comes out after this session. And I'm going to pass it to Julie for another resource that she identified to talk a little bit about.
So we found this online tool, and it's the web address is findabetterbank.com. And mostly it focuses on national banks, not regionals, and definitely not credit unions. But it's a really interesting tool because it's this business that basically you don't have to put your personal information in. You put in your zip code so they can kind of locate what's around you. But generally, what they're trying to do is collect information for banks to give them information about why people are leaving them. So basically, you go in and they provide like kind of unbiased results based on what your needs and priorities are. And so some of the things that they ask you to answer, you know, is this not important to you? Is this nice to have, or is this critical for you to have? So they'll ask you about whether interest on balances is important, overdraft protection, online bill pay, electronic banking services, discounts or freebies. To determine the fees, they'll ask you for the range of how much money is being deposited into your checking account as direct deposits, your lowest daily balance, how many times you withdraw from an ATM, and if you use other bank ATMs to withdraw funds, how often you use your debit card, and if overdraft protection is needed. And also how many times your account was overdrawn last year. So it's a useful but imperfect tool if you or your participants are interested in finding a bank in your area that will serve your needs. So it's location specific, but again, it does exclude small regional banks and credit unions.
The next thing I put in the chat is just our kind of running list of, from these sessions, resources that we are pasting, and we invite you to also add if you have. So we talked about some of there's a video about postal banking history, some other resources that we mentioned. We have been placing things on that. So I pasted the link and feel free to yeah, browse that or add things that you have. We are coming to the end, so these are the last reminders. We have RE-Conference, which is a conference that Neighborhood Partnerships plans. It's coming up in about a month. If you are planning to come, you're gonna put up a thumbs up. It'd be great to see if some of you all, I know some of you all will be there because I have the inside information, but for this group to know that it'll be a chance to move away from the screen and into real life to talk about economic and housing justice. It's 2 days. There's also a marketplace of IDA vendors, which is really a fun part of the conference, sort of a happy hour on Monday afternoon, and then a bunch of breakout sessions on Tuesday. So if you have not yet done so, or somebody from your organization has not yet done so, we do have scholarships that we're holding at least one per organization to subsidize your participation. So that's travel, hotel, registration, one per IDA provider at a minimum. So we encourage you to apply for a scholarship if you want, register if you are able to, and we hope to see you there for some good engaging content.
So we'll wrap it up. Evaluations, posting that now in the chat. As always, that's an opportunity for you to provide us feedback so that we can advance this community learning space so that we're all benefiting, growing, and serving the savers and the folks that we work with. And also extending an opportunity that at the upcoming session for understanding your credit report and score on November 10th, we're looking for a volunteer to step into the space and share or present a teaching tool or method on credit for the next session. So if you're interested, you could reach out to us directly via email, or there's also an opportunity in the eval to indicate that you have an interest, and we will touch base with you offline to pull you into that. So as always, great opportunity. We'd love to see folks share their shine with others. And we appreciate you for being in the space. Hope to see you at RE, and I hope you enjoy the rest of your day.